Assalamu alaikum wa rahmatullah. Welcome back to Green Valley Digital Classes. This is Aman, and today we shall be discussing the second part of this video, that is the principles of insurance. In the previous lecture that we discussed introduction to the services, its features, and two services that we took upon, that is banking, its types, its functions, and the introduction to the insurance. To just recap in just few brief moments, insurance is simply a contract between two parties, insured and insurer, wherein one party insures the other and compensates the loss, or we can say indemnifies the loss in case the insured has suffered any damages. So we can say that insurance is a contract of indemnity. And we discussed all its nitty-gritty, that is who is insured, who is insurer, what is insurance policy, what is insurable interest, what is insurable amount, all these things. Now what we have to discuss is the principles of insurance. The first principle that we have to discuss today is that principle of insurable interest. This principle is very important as far as insurance is considered. So when we say principle of insurable interest, it simply refers to that the policy is taken up by the insured of a very particular object or very particular item in which he has some interest. And when we say interest, which interest are we talking of? We say economic interest. So anyone who is taking an insurance, who is taking up an insurance policy of any object, is taking up the object because he has some economic interest. And what do we mean by this economic interest? This economic interest refers to that if something happens to that particular item or object, if it gets damaged, his economic viability will decrease, or we can say his economic value and the condition will deteriorate. So supposedly, if a person having a shop, and in his shop he has plenty of products, and if something happens to his shop, it will cause an economic loss, and because of that economic loss, his life condition will be deteriorated. So he has an interest, and particularly economic interest, in that particular shop if it gets damaged. So if that shop gets damaged, his economic position will be deteriorated. He will not be able to live off his life in a better way. So what does he do? He insures this shop. He insures these products, so that in case any damages are there, in case there is any loss, this loss shall be compensated and his condition will remain unaffected. So any object in which you have an economic interest, and we will call it insurable interest, where you would like to protect it. For example, this particular marker, if it is damaged or if it is not, doesn't make that much of difference, because if it is damaged, I can get a new one. So the damage to this marker will not cause any deterioration in my situation. My condition will not get worsened. So I will not take up the insurance. While as my automobile, my motorcycle, my house, my laptop computer, where there are some valuable essentials recorded. My house, there are some valuable items. I live there. If something happens to that house, my condition will be worsened. It will affect my life. So my house, my automobile, my motorcycle, my laptop becomes my insurable interest. So this principle says that you will take up the insurance of all these items wherein you have the insurable interest. And the second is, that is utmost good faith. Another very important principle as far as insurance is considered. So when we say principle of utmost good faith, what do we mean by utmost good faith? We have two parties, insurer and insured. One who offers the policy, one who takes up the policy. So the faith is, it's good faith. It is not bad faith. So good faith is, insurer will feel that insured will disclose all the necessary details, all the required details truthfully, in good faith. And insured will have the same faith on insurer, that insurer will disclose all the terms and conditions in the policy. He will not cheat me, he will not deceive me. So they are both showing good faith on each other. Supposedly, if insured is taking up the policy for his car, if it is already damaged by something, he will disclose it to the insurer that before taking the insurance policy, this car was already damaged. And supposedly, if insurer is providing the policy to insured, he will make sure all the terms and conditions are understood and agreed by insured. He will not hide any kind of detail, any kind of clause in that policy which insurer might feel will benefit me in the future because of the negligence of insured. So they are showing good faith on each other. They will both have faith that we will not deceive each other, the other party will not deceive me, I will not deceive them, we will be truthful, and everything that is to be told, that is to be disclosed, shall be disclosed before getting into that contract of insurance. So that is what we mean by principle of utmost good faith. Then we have principle of indemnity. Like in the introduction also, we said that insurance is the contract of indemnity. And in the introduction part, we didn't explain it much because we had to discuss it in this very particular topic. So when we say indemnity, the insured will be indemnified by the insurer. So insurer provides him the indemnity in case of any loss. So what do we mean by indemnity? Indemnity means that if a person suffers a loss, his condition is worsened. So he is deteriorated in his condition. So indemnity says that we will compensate the loss so that we shall bring this person to his original position. Supposedly, if a person has suffered the loss of 10 lakh rupees in his shop, the products of worth 10 lakh were destroyed by fire or by something, so the compensation shall be 10 lakh. Why it is not 11 lakh? Why it is not 12 lakh? Because it goes against the principle of indemnity. If we pay him 11 lakh, if we pay him 12 lakh, that means his position is now better than before the loss. So indemnity says no, we have to put him back where he was before the loss. So his position was here, the loss occurred, his position deteriorated. So we compensate his loss and put right back where he was before the loss. So indemnity is, I will compensate the loss. I will not make your position better. I will just compensate the loss to the amount which you have suffered, so that you are in the same position which you were before this loss. Then we have principle of causa proxima, or we can say proximate cause. When we say proximate cause, simply refers to closest cause. And what do we mean by closest cause? Supposedly, we have taken up fire insurance, and we know that the compensation will be paid only when the damages to any building, to anything, is due to the fire. So, if there was a short circuit and the building was destroyed, half of it by fire. So, one cause is fire, but the smoke also damaged the roof and some other walls. And there was earthquake which damaged other walls. So there are three causes which have caused damage to the building. So when the assessment will be done, so the closest cause shall be taken, and the closest cause is damage caused by fire. So only that compensation will be paid where the fire is the closest cause, not smoke, not earthquake. Even though they both cause the damage to the building, but the principle of causa proxima says that if there are multiple causes to the damage of the property, then the nearest cause, the closest cause shall be taken, and here the closest cause was fire, so any damage caused by fire will be compensated back. So the causa proxima simply says if there are multiple causes, only the closest cause will be taken up, and the damages caused by that very particular cause shall be taken as the damages. Then we have principle of contribution, the fifth principle. Principle of contribution says that if there are multiple insurers, A, B and C. For example, my house is insured by A firm, by B firm and by C firm. And with A, I have taken up the insurance of 10 lakh. With B, again I have taken up the insurance of 10 lakh. And with C, I have taken the insurance of 10 lakh. So they are both my insurers and I am their insured. And they will provide me compensation up to 10, 10 and 10 lakh. Supposedly, my house was damaged up to 8 lakh. So, these three firms shall contribute collectively to the amount that the damages have occurred. So, they will not pay me 8 lakh, 8 lakh and 8 lakh. That will be 24 lakh, which goes against the principle of indemnity. My position is better off than before the loss. But principle of indemnity says no. We will put you in the same position in which you were before the loss. So these three firms will contribute and they will compensate my 8 lakh worth of damages. So this is what we say of principle of contribution. And then sixth, principle of mitigation of loss. What do we mean by principle of mitigation of loss? When we say mitigation of loss, it says that the insured will take each and every step, will take each and every precaution so as to reduce the damage. Supposedly, if I have taken up the fire insurance and I have not installed proper wires, I have not installed proper circuit breakers, I have not installed certain measures which can stop or even reduce the possibility of fire. So I have not taken any step to reduce the initiation of fire damage or causing of fire. So I have not mitigated the loss. All I have done is left the building as such. Yes, I know I have insurance. Tomorrow I know short circuit might happen because of poor circuitry, because of poor wiring, because of lack of measures I have taken. So these things are not in good faith, because in the principle we said they will show good faith. Insurer will have faith on insured that the insured will mitigate the loss, will take all the measures possible so that the loss is reduced. If the fire occurred, if the fire is initiated and I have installed best of sprinklers, I have installed best of circuit breakers, I have installed best of wires, so the possibility of fire is reduced. So I have mitigated the loss. It is not that I have insurance and I will let loss happen because I am insured and I will get the compensation. No, it goes against the principle of utmost good faith. You did not come up to the faith of the insurer. He entrusted you that you will mitigate the loss, but you didn't take any step so as to reduce this loss, so as to reduce the frequency of causing this fire. Again, if we are in a shop and we have not installed a proper security measures and no sprinklers, no fire extinguishers, no circuit boards, no wire breakers, nothing of sort. And I know sometime, and I'm using one socket for multiple plugs. It is bound to catch fire. So I am initiating, or I am pushing this towards the damage. So it goes against the principle of mitigation of loss. So the 6 principles are: first, the insurable interest, then utmost good faith, then contract principle of indemnity, then principle of contribution, and then principle of mitigation of loss. So these were the principles of insurance. So now coming to the second part of this topic, that is types of insurance. As far as types of insurance is considered, we have 3 types of insurance. First one is fire insurance, second one is life insurance, and third one is marine insurance. Again, the basic principles shall remain same. We will repeat some of it, that fire insurance, life insurance, and marine insurance, all the 3 are contract of indemnity, because compensation will be given. Yes, the only difference is that here the cause shall be fire, here the cause is death, and here the cause is any water body. So the cause only differs, otherwise they all 3 are contract of indemnity. Here the compensation shall be paid if the damages are by fire. Here the compensation shall be paid in case of death. Here the compensation shall be paid in case of damages caused by sea or any other water body. And again, these 3 insurance types will have utmost good faith, will have insurable interest, will have mitigation of loss. So these 3 types of insurances, they are same on every level. Only one difference is there, that the cause will change. Here the cause of the damage is fire, here the cause of death, here the cause is damages by any water body. But another difference, that is that life insurance is the only insurance where there is no principle of subrogation. What do we mean by principle of subrogation? Subrogation says that in case there is a damage to the property and you have received the insurable amount. For example, goods of rupees 5 lakh were damaged in fire and I received rupees 5 lakh from my insurance company. The damaged goods now will belong to the insurer. So the damaged goods will be now the property of insurer. I will not possess them, because if I possess them, there may be a chance some of the goods I may sell off and I received the damages plus I sold the damaged goods. So my position is better than before. It goes against the principle of indemnity. So principle of subrogation says you have to hand over the damaged property to the insurer. It is his property. This is the difference. In life insurance, if somebody dies, you do not hand over the body of a person who has died to the insurance company. They come and verify the death and that is it. So the principle of subrogation applies to fire and marine, but it does not apply to the life insurance. So as far as the first insurance type is considered, we can say that fire insurance. So fire insurance is a contract of insurance or a contract of indemnity between insurer and insured, wherein insurer, in consideration of an amount called premium, compensates the loss caused by the fire. So everything else is same. The only thing that has changed is the damage is due to fire. And when we say types of fire insurance, first is specific policy. Specific policy is a policy wherein the damages are valued up up to a specific amount, and this specific amount can be paid and it can be ascertained. What do we mean by damages can be valued to a specific amount? If supposedly a shop having the goods and the fire was caused, and when we assessed it, the damage was up to 5 lakh. So there is a specific amount to which this policy has valued the damage, and we know the total value of goods was. So there is a specific value to the policy itself. So there is a value to the goods which have been insured, and we can ascertain the amount to which the damage has been caused, and that damages will be paid. So that will be called as specific policy. Again, we shall repeat, is a specific policy where you can ascertain the sum of the value of the property. My house is of worth 50 lakh, my shop is of worth 25 lakh, my car is worth of 10 lakh. So you have ascertained the amount to which the value of the property is. And even so, you can ascertain the value to which the damages have been caused. So that becomes specific policy. But what if I cannot specify to what amount the damages have been caused? For that, we have valued policy. Valued policy is a policy which is taken for some precious items, jewelry, or any form of art, paintings or something, where we know that if there is a painting and there is a small cut on the painting, the canvas, I cannot ascertain how much of damage this is. So here the whole policy shall be ascertained. So if this painting was assured for 25 lakh or insured for 25 lakh, even a small cut will be liable for payment of 25 lakh. So in valued policy, we cannot ascertain the sum of damages. If there is a painting, if there is some jewelry, there is some crack in that gem, we cannot ascertain how much this damage costs. So there the valued policy is used. Then we have average policy. Average policy is a specific or a special type of policy wherein the policy contains average clause. And what do we mean by average clause? Supposedly, my property is worth of rupees 10 lakh and I insured it for 8 lakh. So you can see that the amount or the value of the property is 10, but the value of policy is 8. So I have reduced the value of policy. Maybe because less premium I would like to pay. For 10 lakh there will be higher premium, for 8 lakh there will be less premium. So what do? I take up the policy of 8 lakh even though the policy is of the property is of 10 lakh. So if this happens, average clause is put in the normal policy and it becomes an average policy. So what does this average policy does or average clause does? If you have suffered a loss, you know that the maximum amount that is insurable is 8 lakh, even though the value of property is 10 lakh. You will not get sum of rupees 8 lakh as compensation. You will get less than it. For example, so what is the insurable amount? It is 8 lakh. And what is the value of the policy property? It is 10 lakh into loss. So whatever is the loss, this average will reduce the amount of compensation that will be paid. Supposedly, if the loss was 5 lakh rupees, because I have average clause in my policy, I will not be paid 5 lakh, I may be paid 4.3 lakh because of the average clause. I have reduced the value of the property so that I can pay less premium, and when the damages are there, my full damages will not be paid, it will be reduced by this amount. So that is average policy. Then we have floating policy. Floating policy is for those businessmen, for those traders, for those entrepreneurs who have business operations in multiple parts. Supposedly, I am a trader and I have a shop in Srinagar, I have a shop in Delhi, I have a shop in Mumbai, I have a shop in Bangalore. So I have 4 different shops. So what do? Normally, I may take up 4 policies for each shop in different cities. But there's an option for floating policy. It provides all the cover for all the shops. So I will take only one policy, my whole shops will be covered under that policy. So no need to get separate policies. So floating policy will float from one place to another. So wherever the damage will occur, let's suppose the damage occurred in Delhi. So the damages will be ascertained and according to the policy, the compensation shall be paid. So normally what I had to do is go and have different policies in different states. But floating policy provides me the whole cover for all these shops around different places. But the condition is those shops should belong to a single owner. It cannot have a multiple owners. If it has multiple owners, then floating policy shall not be possible. Then you may take other policies which you would like. So these were the types of fire insurance. Then the second type is life insurance. Again, life insurance is the contract of indemnity wherein insurer, in consideration of a sum called premium, takes up the damages or pays the amount in case of death or expiry of a period, or we can say maturity of a period. So there are both the things involved. Either there will be death or there will be expiry of the period. So either of the two, it will be covered under life insurance. So the first type of life insurance is whole life policy. Whole life policy is the simplest and the most general form of life insurance there is. And the compensation shall be paid only after the expiry of the person. Or expiry, we can say, only on the death of that person. So supposedly, if a person has taken up the policy in 2001, it will only mature only at his death. Whether he lives 100 years, whether he lives 60 years, whether he may live 30 years. The time period is irrelevant. Only after his death, this policy will be matured and the insurable amount paid to the beneficiaries who are mentioned in the policy. So that is what we call as whole life policy, where there is no time period, only the compensation will be paid when the death of the individual has occurred. Then we have endowment policy. Endowment policy is a policy, a life insurance policy, wherein the compensation shall be paid either on the death or expiry of time period, or we can say maturity of the time period, whichever is earlier. Again, if a person has taken up the policy in 2001 for 30 years, so now there's a time period. Here there was no time period. Only the death of the person shall make company the liability for paying of the compensation. Whereas here the time period has been initiated. So 2001 he has taken up the policy and for 30 years. So if he lives beyond 30 years, but on the completion of 30 years, he will be compensated. So we said either death or expiry or the maturity of some time, whichever is earlier. But if a person dies before 30 years, he dies in 2020, only after 20 years. So again he will receive the compensation. So either the death or expiry of any period or maturity of that policy, whichever is earlier, the compensation shall be paid. Then the third policy that we have is Janata policy. Janata policy was a specific policy or a special policy that was introduced in 1950s, and it was focused towards elderly people. And this policy shall mature at the age of 60 years. So when that person reaches the age of 60 years, this policy will mature and he shall be given the amount. But in case the death occurs before 60 years, then also the insurable amount shall be paid. So if somebody is of 40 years age and he will take up Janata policy, we know that it will mature on 60 years. So this policy is for 20 years. So if the death occurs before 20 years, that person's beneficiaries will receive the insurable amount. But if he lives up to the 60 years, so 60 years he will reach his age and this policy will mature and he will receive. It is created like a protection of that person after he has crossed 60. Maybe he has retired now, he has no source of income. So this insurable amount shall become a source of living for this very particular person. Then we have joint life policy. Joint life policy is another special type of policy which is introduced. If a family has 5-6 members, it has a father, his wife, his children. Normally what he has to do, either he has to take up whole life policy for each and every one, either he has to take endowment policy for each and every one. So collectively they might have 8 policies. But what joint life policy does, that they will collectively take up the policy. So these 6 members, their father will take up a joint life policy or joint family policy, and all the family members will be covered in this policy. Supposedly if the father is expired, so the insurable amount will be compensated and provided to the wife and the children. Supposedly if wife dies, so the amount will be transferred to the husband and to the children. And supposedly if some of the children may die, so the insurable amount will be transferred to either father or the mother. So joint life policy is special because all the members of the family, they take up the policy jointly. They don't take up separate policies. Then we have convertible policy, wherein a whole life policy can be converted into endowment policy. So before, it didn't have any time period. It will only expire on the death. But if I want to put some time period into it, it becomes endowment policy. Certainly, here the premium is less. Endowment policies have premium more. So if you are converting the whole policy into endowment, the premium shall increase. Now, endowment policy will have both death and expiry of a time period as a cause of compensation. So these were the types of life insurance. Then the last type of insurance that we have is marine insurance. So as marine insurance, the name in itself suggests that it is a contract of indemnity where the damages are caused by marine body or by sea perils, the dangers at sea. But why would somebody go to a sea? We are not talking here of somebody going to the sea or having some fun there or surfing there, boating there. No. It is for those traders, those business houses who conduct international trade, who conduct internal trade but through sea. And we know that when we have to travel long distances through sea, ships are used, big containers are used to transport goods, and it takes plenty of days, plenty of time, and there is always a risk at sea. So any damage caused to the ship, to the goods, shall be covered under marine insurance. So it is not for the person who is going for recreation to the sea, for surfing, for enjoying. No, it is for the trading of goods, wherein the ships take large number of goods from one place to another. So the types of marine insurance, first one is hull insurance. Hull is a technical term for the ship. So the ship which is carrying the goods, let's say from Indian port to Saudi Arabia or some other country, it has to travel long distance. there is a possibility that ship might be damaged. Maybe because of some iceberg, maybe because of some pirate invasion, maybe because of some turbulent weather there. So the ship which is damaged, it will be covered under hull insurance. So any damage caused to the ship by sea dangers shall be compensated. Then we have cargo insurance. Cargo insurance is another type of insurance wherein the goods are insured. So the ship we insured, but it carries goods also. So if ship is damaged, it's most certainly goods also may be damaged. So we can get insurance of the ship through hull insurance, but what about the goods? They'll be covered under cargo insurance. So if anything happens to these goods at sea, they are damaged, so the compensation shall be paid up to the amount of damages. Then the third is freight insurance. Freight insurance is the insurance of rent. Freight is the technical term for the rent which is paid to the shipping company for transporting these goods from one position to another. So the freight or the rent will be paid only when this ship will reach its destination. In case the ship got damaged and the goods got damaged, the ship will not reach its destination. So if it does not reach its destination, the rent will not be paid. So again, the shipping company will have a loss. Their ship got damaged and now they don't receive any rent. So what to do? So in case of non-payment of this rent, because the ship was damaged and it did not reach to its destination, this rent also will be insured. And if the rent was to be paid 2 lakh rupees and they didn't pay the rent because the ship didn't reach its destination, it got damaged. So the rent 2 lakh rupees which was to be paid is a loss. These 2 lakh will also be covered under the freight insurance. So these are the 3 types of marine insurance that we had to discuss. So this concludes the insurance topic of this chapter. Now the third form of service that we shall discuss is communication. When we say communication, we say it's a process of exchange or transfer. But what do we transfer? Of ideas, emotions, information from sender to receiver through a medium to create a common understanding. A very comprehensive definition of communication. So let's break it down. It is a process, that means there is certain logical order of how this communication takes place, and there is an exchange or transfer. So there is an exchange, and we know a single person cannot exchange. There has to be 2 parties. So exchange between 2 parties, and what are those 2 parties? Sender and receiver. So it's a process of exchange or transfer between sender and receiver. But what do they exchange? Ideas, emotions, and information. We can call it a message. So it is the process of exchanging messages, which can be any ideas, emotions, information between sender and receiver through a medium. This is also another important part of communication. Medium should be there. When you call somebody, the medium is telecommunication system. When you talk to somebody, the medium is air. When you send a postcard, the medium is postal services. So medium is very much important as far as the communication between sender and receiver is. If there is no medium, exchange cannot be possible. And why do we exchange? Sender, why does he exchange information with receiver? Why receiver exchange information with sender? To create common understanding. So these two parties will come to common understanding. They will understand each other. Imagine nobody talks. Can we say that we understood something? No. When somebody says something, communicates, and other person says, yes, I have understood. So communication has happened, and this communication has resulted in creating common understanding. So the different parts of communication is, first, it's a process. Second, there is an exchange. Third, there is a message. Fourth, there is sender and receiver. Fifth, there is a medium. So if we have to depict this communication through a process, so this process we need to remember well, because this is the basic form of your communication process, and we can add some other things, but this shall be its simplest form. So we have sender, we have receiver, we have a message, we have a medium. So sender sends message through medium and it is received by the receiver. So sender is the one who creates the message and sends it through the medium, and receiver is the one who will receive this message and who will try to understand it. And receiver sends feedback to the sender. This is the part which makes the whole thing as process. Feedback is very much important. If feedback is not there, it cannot be a process, because it will end only there. Sender has sent the message, receiver has received it, but no confirmation of whether receiver has received the message which sender was intending to send. Supposedly, if you are sending an SMS to your friend and he never told you that whether he received the message or not, you will assume that he understood what you wanted to tell him. Receiver did not receive the message. So how come the common understanding will be created? So common understanding is created when there is feedback. Receiver will provide feedback to the sender. Yes, the message is received, the message is decoded, and understanding is created. And this whole process is disrupted by noise. So this whole communication process is disrupted by noise. So noise is not what we say, like in common terminology we say shore. No, it is not shore. Noise is any element which disrupts this process. Simple example, if you are calling your friend and network area is not good, so the conversation is cut in between. Your friend says that I am not able to understand, please come out of your room. The words are not clear. That is noise. If there is too much of traffic in the internet, you sent an email, but email is half delivered to your friend. The full message is not delivered. So the congestion of the network, that becomes noise. Or if you are talking to a friend and there is loud noise coming from the outside, your friend is not able to understand what you are saying, that is also noise. So noise is not only shore, noise is anything, any element that will disrupt this whole process. So the communication is the process between sender and receiver. They exchange message through a medium, receiver provides the feedback, and the common understanding is created. We can also add one more point to it, that is encoding and decoding. Encoding is simply when the message is constructed, when the message is coded. When you write to your friend, we shall meet tomorrow at 12 p.m. at Lal Chowk. This is the coding of message. You are giving time, you are giving the destination, you are telling him where to meet, and receiver decodes it. He understands that what do you mean by 12 p.m., what do you mean by Lal Chowk, what do you mean by center of the Lal Chowk, or at some shop. Imagine if it only reads, I will meet you up. It's a half message. It becomes noise. Your friend will not be able to decode it properly. He will not understand where do you want to meet. There are plenty of places to meet up. At what time do you want to meet up? So feedback is very much important so as to complete this whole process. So this is what communication process is. And as far as communication is considered, we can have telecommunication and we can have postal communication. So telecommunication, as we are all aware of, where telecommunication devices are used through wireless or wired networks. You have your cellular mobiles, you have your landlines, you have your fax machines, you have your email services. They are all part of telecommunication devices and they are used for communication. And postal communication, wherein the post offices are used, postal services are used, where the letters, cards, parcels, couriers are sent from one place to another. Imagine when you used to write a letter to your friend and you used to post it in the post office and they will take it to your friend. So the postal services became the medium between sender and receiver. They will take up the postcard, they will take up the letter and they will deliver to the receiver. So these are the two forms through which communication can be created. So this was all about the chapter number 4, that is business services. Hope to see you again. For that time, inshallah, fi amanillah. Assalamu alaikum wa rahmatullah.